Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Hello team, Charlie Jewett here with the Renovating Retirement Podcast, doing episode 140. Finally, today we're going to talk about revenue sharing agreements. Episode 140, exposing revenue sharing agreements. Now, when I first heard this concept, that this actually existed in the world for investors from professionals, I couldn't believe it. I didn't think it was true. And many of you will probably be shocked as well, but the biggest brand name companies on the planet. So if you think, where do I go for my financial advice? Let me go to somebody that has 12,000 offices and $1 trillion under management. Let's go to the most successful companies that advertise during the Super Bowl, yada, yada, yada. And you get there, as it turns out, that may not be the best choice for you based on something called revenue sharing agreements. Now, what are revenue sharing agreements? Well, before we even talk about that, why does this even matter to me? Like, why does this matter to me? I'm the financial services industry whistleblower. When I look at companies advertising that they have $1 trillion under, quote, management, and I say, okay, well, who are their closest competitors? And I go and I see that they've got, 500, 600 billion, or some say they have $1 trillion, 1.1 trillion, 1.25 trillion. If you just do a quick search on Google for the, top money managers or who has the most AUM, assets under management, you can see. And by the way, assets under management, or AUM, basically is just code for money that they're gambling for you and charging you a fee, right? So when you look at this, we're talking like trillions of dollars. So the group of people that I'm here to protect, to educate, and to guide, the pre-retiree or the retiree, so whether you're in your 20s, 30s, or 40s, or you're 50s, 60s, 70s, enjoying your retirement, whatever's going on in your life, this whole world of financial planning and accurate data is my world. This is where I live. This is where I fight. This is where I get bloody on your behalf. So revenue sharing agreements are a giant red flag for me, and I want you to understand that they're out there, know how to ask for them, and then as you read it, I'd like you to ask yourself, do I agree with this? Is this something that I really would want in my life? Now, I did a search, and there's a ton of articles, but I found an article, fool.com, I guess that's a motley fool, right? Where someone's talking about this. So I don't know, I didn't read all the articles. I read some of them. I've been doing this for years, so I've got some experience with this. But this particular article is from, looks like Selena Marangian. That's a cool last name. And it says, this is on the Motley Fool, beware of revenue sharing. So maybe you could just type into Google, beware of revenue sharing, Motley Fool, and you'll find out, you'll find the same article. But just a couple things from here. She's like, have you ever heard of the practice called revenue sharing by mutual fund companies and brokers? It might sound like a good thing. It has the word sharing in it. After all, and we've been all told how nice it is to share. But the money being shared isn't being shared with you. It's actually your money, and it's being shared with others. Now, she goes on to say, the practice involves a mutual fund company paying a broker that sells shares of one of its funds to a customer. So basically, let me put this in layman's terms for you, okay? If you go to Edward Morgan Lynch Financial and you say, I would like the best funds for my, for who I am. And by the way, I don't, I don't agree with this, but they're going to start with risk tolerance. What's your risk tolerance? How much can you afford to lose? And they never even consider not losing, which for the last 18 years has paid more than risking money. So losses are completely overrated and outdated. You don't need to take losses in portfolios anymore. It doesn't have to be gambling. Guys, just because there was a time in our history where we didn't have safer strategies and you had to gamble, doesn't mean that gambling works or is the best option. Things evolve. People get better. Guys, we're not drilling holes in each other's heads anymore, bloodletting to try to let sicknesses out. Right? I hope you're not. So we don't have to go, I'm just going to gamble everything and just see what happens. No, you don't need that anymore. Gambling has to be profitable and make more money than safe things, or else it doesn't make any sense. So let me get off my soapbox, because I'm always on that soapbox because it's so frustrating to me. But if you're going to go to somebody and say, I want you to gamble with my money and I'm going to pay you a fee, that's almost every financial advisor on the planet, by the way, they're going to choose which funds to put you in. And there's, what is it at this point? Over 8,600 mutual funds, might even be over 10,000. There's tens of thousands of choices of where they can put money. Long story short, a revenue sharing agreement is when the companies that offer these funds pay a kickback or pay an incentive to the big group, the big joker broker firms, to have them steer their clients into their funds, whether they're what's best for them or not. So nothing surprising here, right? I go to Mexico for my girlfriend's dental work a lot, and we see stuff like this. Somebody's offering, trying to steer you over to this booth so you'll buy from them. Somebody's trying to steer you over to this grocery store so you'll buy for them. And there's some sort of kickback arrangement happening, right? There's nothing wrong, so to speak, with capitalism and commissions. I mean, I'm an insurance agent, for heaven's sakes. That's one of the licenses I carry. What does that mean? That means if I put you in a certain company's products, they'll pay me a commission as a thank you. Well, all of them will do that. The problem with revenue sharing agreements is that there's just certain ones that are paying commissions, so to speak, or kickbacks, and you're being steered into those when something else might be better for you. So there's nothing wrong with the commission, so to speak. It's just how it's being used. So let me just read one of these for you, okay? They're not that easy to find. I was kind of disappointed. It seems like they move them around and they hide them and rename them and everything. They're certainly not that easy to find. If you put in your company's name and revenue sharing agreement, you may or may not find these. I'm going to read one from a very, very big, they've got over $1 trillion under management, very big, very popular firm that has offices just all over the place. So I know, tons and tons of people in every city are using these guys. So it says, Blah-de-blah receives payments. By the way, their name's not Blah-de-blah. I'm just going to hide it so that I don't get sued. Blah-de-blah receives payments known as revenue sharing from certain mutual fund companies, so only certain ones, 529 plan program managers, and insurance companies, collectively referred to as product partners. Aw, it just sounds so benign. Product partners, yay. They make it sound safe. Virtually all of blankety blank's transactions relating to mutual funds, 529 plans, and annuity products involve product partners that pay revenue sharing to us. So basically they're revealing to you that we always choose to send your money to the places that pay us commissions. Not what's best for you, but the places that pay us a kickback. Let's continue. We do not receive revenue sharing payments on assets within investment advisory programs. We want you to understand that blankety blank's receipt of revenue sharing payments creates a potential conflict of interest in the form of an additional financial incentive and financial benefit to the firm, its financial advisors, and equity owners in connection with the sale of products from these product partners. Well, that's kind of clear. They're basically just saying there's a potential, I wouldn't say it's potential, but there is a conflict of interest when they make a whole lot more money sending you to certain mutual funds than they would to have you do your own research, study the best mutual funds, and go into those. That's interesting. For the year ending December 31st, 2017, we made approximately $181 million from mutual funds, blah, blah, blah. $5.6 million from annuity products, blah, blah, blah. Let's see. We don't need to read this part. These payments, this is important, these payments are in addition to standard sales loads, annual sales fees, expense reimbursements, sub-transfer agent fees for maintaining client account information and for providing other administrative services for mutual funds, shareholder accounting, and networking fees. These payments are also in addition to fees for maintaining technology and providing other administrative services for insurance products, in-force contract service fees, and reimbursements for education, marketing support, and training-related expenses. My, what big fees you have. Some product partners pay us a fee based on the value of assets under management, known as an asset-based fee. Blah, blah, blah. So it's a percentage. That's fine. Other product partners may pay us a one-time fee based on the amount of the product. This approach is referred to as sales-based fee and is based on dollar value. Okay, fine. Most, but not all, of product partners that pay revenue sharing to us have been designated as strategic product partners by us. Strategic product partners were known as preferred product blah, 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 blah. They're talking about semantics. There's a piece here I want you to hear. Here we go. The company, so blah-de-blah company, they're talking about themselves, grants strategic product partners greater access to certain information about its business practices. In addition, these product partners have frequent interactions with our financial advisors to provide training, marketing support, educational presentations. Non-strategic product partners that pay revenue sharing may receive similar treatment. All right, that's probably enough. So I'm reading directly from the disclosure from their website. And if you're working with a company that's gambling with your money, meaning it could go down or it could go up, and in some way you're paying fees, you probably have something like this that they haven't given to you that you can go find. And we can review it together, or I can review it for you. That's fine. But basically what it's saying, just so you understand, it's a disclosure they're required to give you by law that's saying, in addition to the excessive fees that we already have that are going to eat into and chew into your retirement, because remember my previous shows? If you just bought the S&P 500 index from Vanguard or somewhere and didn't have a person that you were paying to gambling, more than 70 or 80% of the time, according to research from Harvard, you're beating them anyway. I mean, these are unnecessary people in your life. You don't need to have a professional gambler because they haven't proved that they can make more money than if you just didn't use them. When you do use them, they're legally required to say, we're not going to do what's best for you. We're going to steer you into just the funds that give us kickbacks because that's what my boss and my company make me do so we can go play golf. I want you to be careful of this. I don't have a problem with growth. As a matter of fact, I was just talking to somebody yesterday who already has a significant amount of their portfolio in principal protection strategies, indexed annuities, indexed universal life insurance, things where when the market goes down, you don't lose any money, so you don't have that risk on the table. It's not a risk-reward model. It's a volatility model. We're capitalizing on the fact that the market goes up and down, and just don't lose money when it goes down and make money when it goes up, and you win. All you do is win, 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 no matter what. And we stay there. We're going to do an episode coming up called Win, Win, Win. So this song is on my mind. Hey, you don't have to take risk. But I'm not anti-growth. I think growth is awesome. Income, increase. Increase accounts don't have to be terrible retail mutual fund sales organizations that are going to steer you wrong and jam you into revenue sharing principal partners, or whatever they call it, strategic partners, and rip you off. You don't have to do that. So the message here, and I'm going to wrap this up and keep it short. The message here is, if you have money in the market through some sort of broker, or, let's just say, if you have mutual funds, all right? If you're buying mutual funds through someone who's charging a management fee. So if you're studying your own mutual funds and somehow, I don't know how you could do this, but somehow you determine which 4% are going to go up every year. That's the Tony Robbins research says 4% of mutual funds make money, but it changes every year. If you somehow clairvoyantly can figure out which 4% of the mutual funds are going up every year and you're buying them on your own, then whatevs. You know what I mean? Like, revenue sharing doesn't matter. If you're taking, quote, advice from someone that works for a name brand company, they're not independent. They're part of a big, giant national organization, and they've recommended some, portfolio of stocks, bonds, and mutual funds, and you're spread all over the place, and they charge you a fee for that. Chances are, I can't say 100% of you, but the chances are you're being affected by some sort of revenue sharing agreement that's got you paying extra fees, or minimally, if you were paying the same fees, you're in funds that they're not picking based on whether or not they're the best funds. They're just picking them because their boss told them to, or because their company's partnered with those groups. That's all I want to say for today's show. Just be careful of revenue sharing agreements. Go on Google, do a little bit of research, type in revenue sharing agreements. What are they? Watch some YouTube videos, whatevs. And then get in touch if you'd like help. Charlie@jewetwealth.com, CHARLIE@JEWETT wealth.com. We do have a name change coming up pretty soon, not for the podcast, but for my company. Why would you change the name of your company? Long story, somewhat related to my divorce. And then Renovating Retirement can't be the name of a company in California, and that's where I live. So we had to start completely with a new name, which is L5 Wealth Management. The L5 stands for the 5 Lives of Retirement. Also, another podcast is coming out called the 5 Lives of Retirement Podcast. If you'd like the same teaching without any of the crazy voices, no Mr. T and no chipmunks. But anyway, get in touch, Charlie at jewetwealth.com, CHARLIE at JEWETT wealth.com, or 888-285-2268, and we'll talk to you. I think you people are the best.
But that's all, folks.